Okay, welcome back. So on part one of the video, we were dealing with the definitions under the lessee, okay, that are important for the lessee. Okay, so now I think let's go to the measurement. Okay, so we have a right of use asset. Initial measurement of right of use asset. It is initially measured at cost. Okay, and that cost comprises of the following, and this is very important. ROA is initial measured cost, and the cost of an ROA includes the following. Okay, so it includes the amount of initial measurement of a lease liability. Okay, so we're still going to talk about the measurement of the lease liability, but the amount of the initial measurement of the lease liability should be included in the cost of the right of use asset. Okay, plus any payments made before the commencement date. So what this thing means is that we said here on A, it's the initial measurement of lease liability. Now in B, we're saying any payments made before the commencement date. So what you need to know is that these payments that are made before the commencement date, they are not reflected in the initial measurement of the lease liability. Hence, we are including them separately. Okay, and any initial direct costs that are incurred by the lessee. Okay, so these three things, A, B, and C, they are normal. We see them every day on the initial measurement of the right of use asset. But now there's D, and D is very important. Okay, so D, it says that the right of use asset cost should also include, okay, an estimate of costs that are incurred by the lessee to dismantle and remove an underlying asset, okay, to restore the site to which it is located, or to restore the asset to conditions to the condition that is required by the lease. Okay, so what this means is that, let's just say you were leasing machinery from the lessor. Okay, so that machinery, you took the machinery to your own premises. Okay, and then let's say that machinery had to be I don't know how to say this, or you had to build that machinery, or you had to have a proper site for that machinery. Okay, so when you have, or if you expect that at the end of the lease term you will incur the costs to dismantle that machinery, okay, and incur the costs to make sure that the site where the machinery was is restored to a normal condition. Okay, so those costs should also form part of the right of use asset. So these costs, they're actually those costs that are accounted for in terms of IS37. Okay, so if you remember what IS37 talks about, these are exactly the same costs that we talk about in here. So those costs, if they are in any way related to the right of use asset, they should also form part of the right of use asset cost. Okay, so subsequent measurement. The ROA is subsequently accounted for using the cost model, or the revaluation model, or the fair value model. So my focus, it's only gonna be on cost model, because it is what we see from day to day. Okay, so the ROA will be measured obviously at cost less accumulated depreciation, and also less the accumulated impairment losses. Okay, that's how we account for the right of use asset. It's pretty straightforward and simple. Okay, so now we said accumulated depreciation and impairment losses. What is the accumulated depreciation for an ROA? Okay, so the standard says that it is accounted for in terms of IFRS16. Okay, but there's a big but, which says that certain requirements of IFRS 16 they override the requirements of IFRS 16, such as the following. If you expect, as the lessee, if you expect that you will purchase that asset, or the asset will transfer to you as the lessee at the end of the lease term, okay, you should depreciate the right of use asset over the useful life of the asset, okay, not the lease term, but over the useful life of the asset, okay. Or this is just the same thing as above, actually. Over the useful life if the lessee will exercise the purchase option, okay. So if you know that you have an option to purchase an asset at the end of the lease term, and if you are reasonably certain that you will exercise that option, okay, it means you will get the asset at the end of the lease term, you will own the asset. So if that's the case, again, you need to depreciate the ROA over the useful life of the asset. But here is the very important one now, okay. For all other cases, the ROA should be depreciated early after useful life or the lease term. Now let's say this happened, okay. You expect that you will own the asset at the end of the useful life as the lessee, okay, and the useful life of the asset is actually 3 years, okay, and the lease term is 5 years, of which I don't see that happening, okay. So what this means is that you will depreciate it at the earlier of the useful life or the lease term, okay. If you see, because if the lease term is 5 years and the useful life is actually 3 years, and when you say you want to depreciate it over 5 years, how? Because this asset only has the useful life of 3 years, okay. So this is just what the standard says, okay. But when I come to think of it, it's not possible to have a lease term of 5 years and a useful life of 3 years. I mean, how can you have a lease term more than the life of the asset, okay? So the only thing you can get out of this is the fact that ROA is depreciated over a lease term, but a big but, if you know that you are going to own the asset at the end of the lease term, then you should use the useful life to depreciate the asset. That's what is important from this, okay. So let's talk about the initial measurement of the lease liability now. So it is the present value of unpaid, okay. It is the present value of unpaid lease payments, okay. So if a payment that has been paid already, it's not part of a lease liability, we all know that. So it is the present value of unpaid lease payments that are discounted at interest rate implicit in the lease that we defined above, okay. And if the implicit rates can't be determined, they are discounted at the incremental borrowing rate, okay. That is the initial measurement of the lease liability. Now let's talk about the subsequent measurement. Let's talk about subsequent measurement of the lease liability. So after initial recognition, okay, the lessee shall measure the liability as follows. You increase the lease liability by an interest expense, you reduce the lease liability with lease payments, and you remeasure the lease liability to reflect the lease reassessments or lease modifications, okay. So obviously if you are paying the lease payments, you are reducing your lease liability. If you are incurring interest expense, you are increasing your lease liability. And here is the important one, okay. So remeasuring lease liability to reflect lease reassessments or lease modifications, okay. So the following thing that we're going to talk about is the reassessments of lease liability, okay. So we're going to cover lease liability, and we're also going to cover the lease modifications. Okay, so now let's talk about the reassessment of lease liability. This is also important. Okay, but I will tell you the part that is very important in this thing. So the reassessment of lease liability comes in many forms. Okay, it can come as a result of change in the lease term. Okay, due to the change in the likelihood that an exercise or termination option will be exercised. So you see this thing, it requires you to actually know what a lease term is. Okay, so if there is any change in the variables of the lease term, that is a lease reassessment. Okay, that's number one. Number two, the change in the likelihood that a purchase option will be exercised. Okay, so you know that when you estimate the lease term, you include the options, okay, where you are expecting to purchase an asset, which means also it can also form part of change in the lease term. Okay, and then number three, the change in the payable, oh, the changes in the amount payable in terms of the residual value guarantee. Remember, if the residual value guarantee changes, you need to reassess your lease liability, because you know that the lease liability actually includes the residual value and the guarantee and all other things. So if the residual value guarantee changes, the lease liability will have to be reassessed. Okay, and then the change in future payments due to the change in index, okay, to determine those payments. So if also again you have variable payments, and those variable payments that vary according to an index or rate, they change, you also need to reassess your liability. Okay, variable payments change, or the change in variable interest rate, you need to change your lease liability. So in a nutshell, what this reassessment means, it means that firstly, you need to know how to account for your lease liability, your initial measurement of lease liability. So if you know what variables did you use to get to a lease liability, you need to know that if anything changes in one of those variables, it changes the lease liability. Okay, so but what is important is this part now. Okay, this part is very important. It says if the lessee, okay, if the lease liability changes because of the changes in lease term, okay, or the purchase options, you need to be careful here. If the lease liability changes because of the change in lease term, here's the lease term, or in purchase option, here's the purchase option, this one. Okay, so if it changes because of that, you need to remeasure your lease liability by using the revised discount rate, which means by using the new discount rate. This is important in the remeasurement of lease liability. If it changes because of lease term or because of purchase options, use the revised discount rate. Okay, if it changes for any other thing except the lease term or purchase option, you need to use the original interest rate. Okay, and you should know that the rate should actually be the rate for the remainder of the period. Okay, should actually be the rate for the remainder of the period. So I've already explained this, that other changes in other variables in the liability should be remeasured using the original rate. Okay, so that is the reassessment of lease liabilities. And we also have lease modifications. Okay, but when it comes to lease modifications, I'm just gonna be fast on this. The only reason why I'm not gonna pay more attention on the lease modifications was it's actually on the awareness level. Okay, so a lease modification actually is a change in the scope of the lease or a change in the consideration. Okay, so those two changes in the consideration or in the scope of the lease should be the changes which were not part of the original terms of the lease. So they were just recently introduced now. Okay, so if there are those changes, then there is a lease modification. Now going forward, how do we account for lease modification? We can either account for lease modification as a separate lease agreement, which is it's just something completely new. It has no effect on what was happening before. You are applying IFRS 16 from scratch for that contract, okay, or an adjustment to the existing contract. Okay, so or either you are adjusting to an existing contract. Okay, so briefly, okay, if you are for this particular account for a separate contract, which is practically a new contract. In this case, the modification increases the scope of the lease by adding a right to use one or more underlying assets. Okay, and the consideration for the lease increases by an amount commensurate, which in that case means substantially equal to, okay, commensurate with the standalone price for the increase in scope. Okay, so we were leasing one vehicle, okay, at 20,000 per month. Now we are adding a second vehicle, which means we're increasing the scope at also 20,000 per month. What this means is that the standalone selling price obviously it's also 20,000. So if that happens, you should account for that lease as a separate lease. Okay, I don't think you need to stress yourself more about this. You can just go and read it up on the standard, but that is what it says actually. So lease modification is accounted for as an adjustment to an existing contract. So if it's not accounted for as a separate contract, it's accounted for as an adjustment to the existing contract. So lease not accounted for separately should be accounted for as follows. Okay, determine the lease term of the modified contract using the general principles of IFRS 16. So you need to know the lease term now, the new lease term based on the modification, and remeasure the lease liability by discounting the revised lease payments. Discount the revised lease payments with the revised discount rate. So actually when you do this thing practically, it's not that different on how you do it from the reassessment, but the rules behind are different. Okay, because now everything it's revised lease payments, revised discount rate. Okay, and then you adjust your ROA and your lease liability accordingly. Okay, so but if the modification is as a result of a decrease in the scope of the lease, the decrease, you need to decrease the carrying amount, and you need to decrease the carrying amount of the right of use asset and the lease liability by the proportionate decrease in the scope of the lease, and the difference between those two goes to P&L. So what this means is that you have the carrying amount of the ROA at that date, you also have the lease liability at that date. So if the scope decreased by 25%, it means you need to subtract 25% from the ROA, subtract 25% from the lease liability. So the difference between the two should be recognized in the profit and loss. So it's just a summary of what is happening on the modification. Okay, so now we'll take a break, and then when we come back, we're going to talk about the amendments of IFRS 16 as a result of COVID-19. Okay, this is very important, and I promise you, CTA, ITC, whatever, this thing will come. Okay, because this thing was just amended now around June this year. So you need to pay attention to it. Okay, lovely. So let's just take a break, and then we're going to come back. We're going to talk about the amendments to IFRS 16 as a result of COVID-19. Okay.